I am joined by Matthew Sigel, Head of Digital Assets Research at VanEck. Very excited for this fireside chat. Matthew, great to see you. How are you?
Hey, Jack. Thanks for having me.
It's my pleasure. Matthew, I want to talk about your case for Bitcoin, your view on the current crypto market, and your a lot of the work you've done, which is really interesting on Bitcoin miners as an AI play and how they could contribute to that and benefit from that and their energy, the usage that AI uses. But I want to start with your background because it's very interesting. How did you get into crypto? It's my understanding you used to be a journalist. How does a journalist become the head of digital asset research at an asset management company?
Yeah, it was a winding journey. I started in journalism 25 years ago as a reporter and a producer at Bloomberg, CNBC, and NHK, the Japanese public broadcaster, always covering finance and economics. Uh, Simply put, I got disillusioned with fake news and jealous of interviewing sources who had more zeros next to their personal balance sheet. So I did kind of what every good journalist does, which is a lot of networking. Started studying for the CFA, Chartered Financial Analyst track, and after passing level one of that, I got connected with Kathy Wood, who was then a portfolio manager at Alliance Bernstein, and she hired me to cover tech. So spent 4 years doing global equities at Alliance. I found myself missing parts of journalism, writing something and getting feedback from people instead of just the prices on a screen, which in your 20s and 30s was a little stressful and lonely for me. So I pivoted again and spent 10 years on the sell side at a Hong Kong-based broker, writing research and selling research to institutional investors. And that firm, headquartered in Hong Kong, I spent a lot of time traveling around Asia, Southeast Asia, especially Japan, China, and realized in 2017 that this thing called Bitcoin was getting pretty widely adopted by retail investors in Asia. And I remember coming back from a business trip and talking to my coworkers on the trading desk, like, hey, my taxi drivers are talking about this Bitcoin thing. And they're like, taxi drivers, that's a contrarian indicator. You sell when that happens. And I'm thinking, well, this is a retail asset. It's meant to take power away from, centralized intermediaries, restore it to people who don't have access to the money printing spigot. I actually think this is a positive indicator. So bought my first Bitcoin 2017 and just fell down the rabbit hole of smart contracts. And when COVID came around, I felt like the news industry was even further obliterated. Fake news became more of a thing. And in my mind, people would coalesce around the Bitcoin blockchain where every 10 minutes, everyone can agree what is the truth. And that felt very scarce. So had gotten to know Jan Van Eck and joined here 2021 to help broaden out the product suite. So we now have 20 different crypto products, about 2 billion in assets on a total asset base of about 100 billion.
When you say you got first interested in Bitcoin in 2017, my question for you is when? Because when I first heard about Bitcoin, I think it was October, and that was a few months before the peak of the bull market. I think that the prices maybe peaked in late November, early December. But it was much better to get involved in January 2017 than December 2017. So when in 2017, if you remember?
This was June. So
Okay.
I was writing research. The most clicked on research piece I ever wrote on the sell side was a piece called Google is Evil. It was in 2017. And by now all of that is very consensus, the kind of the winner take all characteristics in digital platforms, how Google managed to basically kill the local classified ads market in the US and local newspapers, and this kind of centralization of truth, which I identified as a long-term structural trend. And the conclusion was by Google, but in the long run, this technology, Google and the other big tech, will be disintermediated. The margins are too high. It's either going to come from technology innovation or from regulation. And it seems right now that kind of most of the mainstream political parties have coalesced around the regulation side, right? Let's sue Google for antitrust. Let's sue Apple for antitrust. Yesterday, headlines, NVIDIA, DOJ investigating for antitrust. I'm more attracted to the let's disrupt these companies' profit margins by offering an alternative product which is better and which doesn't centralize power. So that's kind of how I got attracted to it. But it was June 2017. It was a rocky ride.
It was a rocky ride. Earlier you said fake news. I think almost all of our viewers will be familiar with what that means within the political realm, which I would like to avoid. But because you, like me, we're a financial specialist only covering economics and finance. What do you think is, or similar to, fake news when it comes to financial journalism, whether it's print, digital, or television, or podcasting?
I guess it's when you integrate some biases into your coverage, either by omitting important news or by highlighting news that adheres to kind of one strain of thought. So I've been a Bloomberg terminal customer or employee for the last 25 years, and I've kind of watched the editorial slant of that organization, shift gradually to the left. It got highlighted when Mike Bloomberg ran for president, and the media organization famously did not investigate his past. But you can also see it on the Bloomberg terminal today that the ESG page is above the economics page, right? So you basically get a lot of what I think is meaningless information, and then the true information gets buried. And I think that's become just more of a phenomenon in the last 10 years as everything's gotten politicized.
That's an interesting perspective. I wonder how much of the bias is coming from the audience itself, if you know what I mean. In other words, at the peak of the bull market, everyone wants bullish content, so that's what the media gives them, and people blame the media for fomenting it. But like everyone else in commerce, the media gives people what they want, and at the bottom, when at the bottom of the recession, the bottom of the stock market, they produce bearish content because that is what people want. And maybe people want ESG content even if it is nonsense.
Yeah, it takes time for the truth to come out. Now we see, just came out a couple days ago, that Vanguard voted to support exactly 0 of the ESG proposals that were put forward by shareholders this year. That number has steadily fallen over the last 4 years. So, by some measures, I think kind of 2021, 2022 was the peak for a lot of this leftist narrative around the importance of, net zero, or whether it's kind of racial dynamics. And maybe some of the froth is off that, but I agree with you. A lot of people believe in it. A lot of people want it, and it'll take time to get like fully obliterated, which I think will happen.
So would I be correct in saying that your first love in crypto was Bitcoin, or was it something else?
Yeah, it was Bitcoin.
And what about it? Tell me about that process.
I think there's a strong hunger from citizens in the rest of the world to get permissionless access to hard currency, whether that's gold or the US dollar. And unfortunately, dollars are not available to everyone in the world. The U.S. Department of Justice essentially like oversees the distribution of dollars and will go after anyone who is distributing them unlawfully. When the Fed went on its kind of money printing spree starting in 2009, but then over the next decade, QE2, Operation Twist, like everything that kind of distorted the cost of capital, I just think the awareness globally grew, and my awareness grew alongside of it. And I wanted to be able to hold an asset that nobody could take away from me, that I could, smuggle in my behind if necessary, if fleeing somewhere. And it wasn't a maxi approach, but it was a 5% allocation, and let's see where this goes. And my work at CLSA, which is really an emerging markets geared um, research provider, just reinforced to me that the appetite for these types of assets is way larger outside the US than it is inside the US. And I still think a lot of Americans, throw up their hands with this Bitcoin stuff. What can I use it for? They just are unaware of their own financial privilege. And the fact that we all have 7 or 8 payments apps on our phone, we can, as Americans, we can access them seamlessly. That doesn't exist in the rest of the world. And there's some very interesting data sets. If you poll people, what do you think about Bitcoin? Are you bullish, bearish, or neither? The most bearish countries in the world are Germany, France, uh, Japan. All right. What do those countries have in common? They're very old, full of old people, essentially, and getting older. The most optimistic countries in the world, Philippines, Nigeria, these are the youngest countries in the world, right? So the demographics are clear. The desire for kind of anti-dollar are clear. I remember in 2021, the president of Indonesia said, like, we have to break the monopoly that Visa and MasterCard have on payments. We need a neutral alternative. I'm just very attracted to that alternative, and I think Bitcoin has locked up that market. I don't think any other crypto is going to come along and try to successfully take the digital gold brand away from Bitcoin.
Matthew, when I first heard about narratives theories about Bitcoin replacing the dollar, a lot of what I heard is basically it will replace the dollar in all forms of currency. So not just a reserve asset, a store of value, but also a medium of exchange and a unit of account. So the way I, basically someone in California, someone in Los Angeles is going to go to Starbucks and pay with Bitcoin. I had a really hard time wrapping my head around that and still do, to be honest, just because of how volatile Bitcoin is in dollars. Of course, you could say, oh, well, it's the dollar that's volatile in Bitcoin. And also that, to have an economy, you need a flexible, exchange rate where if you have a recession, a depression, and you have deflation where there is some ability to ease the cost of credit, and you don't have deflation, which then incentivizing hoarding and not spending, which is further recessionary. But yeah, your piece and your work on this, which is on VanEck.com, called Bitcoin 2050 Valuation Scenarios, Global Medium of Exchange and Reserve Asset. You have a totally different framework for how Bitcoin will be used, and you rest mostly on its store of value, and also how it's not going to be people in California, and it's going to be coming from countries that have the greatest financial instability. So, I don't tell people what to do. So I'm not telling people to read this piece, but if they want to read a piece about the future of Bitcoin that definitely has a bullish slant, and how, in a scenario where Bitcoin actually is playing a significant or a much more significant role in the international monetary system, the IMS, as you call it. Yeah, read this piece and don't read other pieces. That's what I would recommend. So just tell us, what is your thinking behind this piece, and yeah, what motivated you to write it?
I agree with you that assuming regular citizens are going to be making $5 Bitcoin payments for coffee and the like is not in our base case. So the adoption, we think, is going to be led by institutions, but not your typical institutions, aka banks and corporations, but rather governments. So this is a settlement, a bearer asset that is best used for large settlements, right? Because the transaction fees are extremely low when you're doing a very large settlement measured in kind of basis points. But if you're making a $5 transaction, you don't want to spend $1 of it. That's kind of the starting point, is like, we do need institutional adoption, but the institutional adoption should probably come from nation states that have been funding US fiscal profligacy and monetary profligacy for the last 15 years. And now they are observing that the US budget deficits are, 6-7% of GDP, even in an economic boom. We will look back at this moment of, huge budget deficits in the middle of an employment boom as something that never should have happened. And I think our trading partners are also looking at that, and they're saying, what are you spending this money that we're lending you on? You're spending it on wars, and some of these wars are very controversial in the rest of the world. You're spending them on domestic policies that probably don't increase productivity, at least some of the equity-oriented policies that the left has been putting forth. Inflation Reduction Act, which did the opposite of reducing inflation. And these problems are, you could argue, even worse in some of the other kind of primary reserve asset nations like Japan. the euro, and the UK. And what we did this data analysis, and what you can see is that these primary reserve currencies have declined in importance because their issuing nations are becoming less economically relevant, i.e., like Japan and Euro GDP per capita is shrinking. All these nations are becoming more fiscally irresponsible. And we think this trend is likely to persist. It's likely to accelerate. And we think that the share of cross-border payments conducted in the dollar, yen, euro, and the pound will fall. Right now, that combined share of those four currencies is about 86%. We have it declining to 64% over the next 2 decades. China will fill some of that gap. India will fill some of that gap. But we think that much of the world can coalesce around Bitcoin as one of those reserve assets, and we make very modest assumptions as to the eventual scale. We assume that central banks will own Bitcoin at roughly a 2.5% weight in their reserves, and then we assume that global trade, international trade, about 1/10 of it, 10%, will be denominated in Bitcoin. So that probably the velocity of Bitcoin will go down because those central banks will be hodlers, not necessarily transactors. And then we did just a simple like velocity of money equation to get to Bitcoin roughly $3 million price target by 2050. And just to put that $3 million in perspective, that implies a 16% compound annual growth rate over the next 2 decades. Our $300,000 target for Bitcoin for 2030, that's a 32% CAGR. So it's rather modest, right? You can see that the growth decelerates dramatically, and that was basically the gist of the work.
Yeah, that really shows the magic of compound interest. $3 million, $2.9 million sounds like a wild price target, but if it's in 26 years, 16, it's only 16% per year, and that's the magic of compound interest. Yeah, we can put up the chart on screen of your predictions of the currency reserves of all countries, showing it from 1999 to 2024, and then your projections going out to 2050. And the de-dollarization that you project or assume, of course, it's a model, from 2024 to 2050 is actually much more mild than the de-dollarization that occurred from 1999 to 2010. Really, Bitcoin gets that, you can barely see it, that orange slice, and it still is a much smaller percentage of assets than the dollar, the RMB, and gold. But I think it's a big step to go from a central bank owning other currencies, the liabilities of other countries, sovereign bonds, and gold, to stuff that has existed for a very long time. Gold's existed for thousands of years. The sovereign bond market, more modern, but it's definitely everyone alive had, and all of their grandparents lived in a time when there was a sovereign bond market. Bitcoin, relatively new, 2009, I believe. How do you think that first transition will happen? In the same way that it took a lot more time for, I imagine there to go from 0 to 100,000 internet users, than from 100,000 to 200,000 or 100,000 to 1 million. How do you see central banks taking the first step? And can you describe what you're seeing already in countries such as El Salvador?
Yeah, that's a good observation, that we are predicting in this piece a 0 to 1 moment, which hasn't happened, and that was like Jan van Eyck's pushback to the piece, essentially, which is, you have no evidence to make this call, go ahead, but I'll believe it when I see it. But the underlying trends are in place. The U.S. dollar's share of global foreign exchange reserves is at a 25-year low. The U.S. share of world trade is at a 50-year low, and we now observe 7 different nations that are mining Bitcoin with support from the central government. So El Salvador was the most famous, and they took it even one step further, making Bitcoin legal tender. But this year, Argentina, Kenya, Ethiopia all announced Bitcoin mining ventures at the government level with surplus energy. in order to earn hard currency. And I think it's interesting that all three of those countries have debt negotiations with the IMF, right, are essentially in default and can use Bitcoin, number one, to earn hard currency, and number two, as a negotiating tool with the IMF. When you fail to repay an IMF loan, they come in, they're like, your default, and we can extend and pretend this loan, but in order to do that, you need to do A, B, and C. And the A, B, and C usually create some internal domestic issues because whoever the party that's in control, the other party accuses them of giving away sovereignty in return for some foreign loan, and it becomes this like domestic issue. And one party can actually lose control because of that. They can use Bitcoin as a negotiating leverage. Maybe they say to the IMF, we're going to make Bitcoin legal tender. Oh, well, don't do that. Okay, we won't do that if you extend this loan, right? Like with Pakistan, Pakistan agreed to increase its collection of taxes on crypto in return for their recent IMF loan, even though crypto is illegal in Pakistan.
Hmm.
So that just highlights that like everyone's kind of interested in this issue. And I think one of these countries that has success on the mining front will just take it one step further and add it to their central bank reserves. I don't know which country that will be.
And yeah, so you said they need to generate hard currency. I think the term hard currency, hard money started with gold when there was a gold standard and gold was fixed. And now that we have the dollar standard, and I learned this speaking with Eric Fine and Natalia Gurishina from the VanEck Emerging Markets team about how if Argentina makes a loan in Argentine pesos, that's a local currency loan. But if they make it in dollars, that's called a hard currency loan. And I think that's going back to with the gold standard when there was a hard currency loan. It's interesting to think of a Bitcoin as a hard currency in the sense that there's a limited number of them, only going to be 21 million. It is harder than gold and much harder than the US dollar, but it does go up and down. So they are making a speculation on the price. I think that is different than the gold standard when the price of gold was fixed. So I assume they would want the price of Bitcoin to go up, but are they still satisfied if it stays stable?
Yeah, when I used hard currency, I guess I was referring to dollars, which is that a lot of these emerging market countries, once they're having major debt problems, there's often capital controls. It's legitimately just hard to get your hands on dollars. So if you have some of the stranded energy, like Ethiopia just built this enormous hydro dam. There's like 15 different Chinese Bitcoin miners there, and the country itself was like, you know what, we better hook up to this too. They can sell that Bitcoin every day and get dollars, and dollars are pretty scarce in Ethiopia.
They mine Bitcoin and they sell the Bitcoin to get dollars, which are hard
Yes.
currency. Thanks
Yes.
for that. And can you describe what happens to the finances of a country when it mines Bitcoin? Because mining Bitcoin isn't free and the hash rate goes up. So there's a halving. So over time, you get less and less Bitcoin. But if the price goes up, that you can be compensated for that or more than compensated for that. Let's say Ethiopia is mining Bitcoin. How does their profits from the Bitcoin that they mine and sell compare to their costs of the operational and capital expenditure to build the mine?
Yeah, unfortunately, most of these entities do not provide the level of transparency necessary to make those determinations. Governments often have access to energy at discounted prices, or energy which is like not available to everyone else. So in the case of Ethiopia, there was an enormous capital investment to build this new hydro dam. I think it was like $6 billion of investment, and then the government kind of gets to decide which industrial customers get access to that energy. And they'll often, on the Bitcoin mining side, will be either a JV with the state-owned utility, or in the case of El Salvador, it's an entity that's connected to the finance ministry. There's not like a pass through directly to the finances of the government, because of the governance structures of these, which are JVs for the most part. So again, that's kind of waiting on that 0 to 1 moment where the linkage becomes more clear, and we just don't know how profitable they are.
And what do you think you need to see or needs to happen for the continued development of foreign nations adopting Bitcoin? And I guess it starts with them mining Bitcoin and selling it to raise dollars, hard currency. The next step would be them actually retaining Bitcoin on their balance sheet, not immediately selling them. And what is a catalyst for this continued adoption? For example, I imagine if the price of Bitcoin were to go up a lot temporarily, that would increase people's, in America, an investor community's interest in Bitcoin. But maybe it's not the case for central banks. Maybe they actually want the price of Bitcoin to stay stable for other instances because they don't want to keep on buying into a rising market. I don't know.
I'm not sure what the catalyst will be. I mean, in Switzerland, there's a petition that gathered enough signatures for the central bank to add Bitcoin as a reserve asset. I doubt that's going to pass, but it might be something like that, which just capitalizes on the existing trends that are already in place, the deterioration of property rights in some G7 nations, and the increasing use of sanctions around the world in developing markets. U.S. sanctioned entities have increased 529% since 2009. So we are increasingly using sanctions to advance our geopolitical interests. And there's a lot of evidence over, centuries that those sanctions can often be counterproductive and can accelerate the adoption of alternative means. So, none of us want to do business with Russia right now, nor can we. You can't help but note that Russia has just legalized crypto for international payments. They're setting up 2 state-sanctioned crypto exchanges in order to facilitate international trade denominated in digital assets. We're looking to the other side. Someday this war is going to end. Russia will be reintegrated into the world financial system in some way. It might be less than it previously was. And at that point, are they going to abandon all of their digital asset ventures? I'm guessing not. And that's why just introducing this small percentage of global trade, which would be denominated in Bitcoin, feels logical to me.
So far, I think we've talked all about the use case of a currency of an asset as a store of value, storing it on your balance sheet. What about as a medium of exchange? So we agree that it's unlikely, or it's not our base case, for people to be buying $5 coffee with Bitcoin. But what about large ticket items? And if you do think that in the future Bitcoin will be used for some large cross-border transactions, what type of transactions? Why are they using Bitcoin? And which type of countries?
Well, if you talk to Chinese Bitcoin miners or some of the companies that make Bitcoin mining equipment that are Chinese, they will tell you that at some point China will be further isolated from the financial system because of things that may happen in Taiwan or other developments. And China itself will be in a position where it wants to use Bitcoin in order to facilitate external trade. So I can imagine that scenario. I think the question is, in the case of like China and Saudi Arabia, like that might be one scenario that we can imagine where like some percentage of the oil trade between those 2 countries would be denominated in Bitcoin. Not all of it, but 5 or 10%. There aren't examples of that happening, and instead what we're seeing is that like Saudi Arabia is making FDI investments in Chinese refineries. So like, hey, we're going to help you build this new oil refinery. Here's $5 billion. And as a result, we're entitled to like X% of the output from that. So that would be evidence to the contrary, because that's what they're doing so far. But in my world, just to use Bitcoin for a small percentage of those large commodity transactions would be intuitive.
Matthew, I've got a question that is going to reveal my level of ignorance when it comes to technology. I'm definitely a finance guy, not a technologist, and that will become very obvious right now. Of if I send a payment from my bank at J.P. Morgan to someone else thing at Bank of America, it's going to go through. It's going to be fine. But if it's not, it does rely upon trust, and that can be a weakness. But there is a legal mechanism of how things can be resolved. What Bitcoin, I think it almost entirely rests upon the technology and a few key claims. Number one, it is a bearer asset. I wanted to explain this. It's just so cool. If you own gold and you have it in your hands, you have it in your vault. By definition, you own it. Unlike, for example, if you own a treasury bond, yes, you have that, but in order to actually get the money and what it represents, you could be sanctioned. There are bearer bonds that the U.S. Treasury used to issue where, if you could have it and you hold it, you literally owned it. So that's why it was very people were incentivized to steal it, and that's what the plot of the movie Heat, a great film. I think bearer bonds, U.S. Treasury bearer bonds are much less common now. But as you said, Bitcoin is a bearer asset. If you have it, by definition, you own it. If Matthew, if you have a flash drive of a ton of Bitcoin and you drop it in Central Park and I pick it up, I am the owner. But just how rock solid are these claims of, if you own it, you own it. And number two, that there's only going to be 21 million of them. Like, how decentralized is it? Just how serious do you take the risk that, Satoshi comes back, or, actually becomes a lot more centralized, and you actually, you thought you owned Bitcoin that you actually didn't?
Yeah, a lot in there, but I think one comment that you made, which is like, if you own gold, you own it. And I saw a story yesterday that Argentina is shipping 62,000 kilograms of its own gold overseas because it needs to be certified before they can use it as collateral. Okay, so the payload capacity of an Airbus 330 is roughly 70,000 kilograms. So this is what this country has to go through, spending tens of millions of dollars probably just to be able to use their gold. So there is a lot of friction. And when you're doing $1 billion transaction, you need someone in the middle, right? A lawyer, some type of escrow agent, and I don't think that's terribly complex. I think existing laws kind of handle transactions that have an escrow or someone in the middle. And fraud is fraud, whether you're paying in Bitcoin or you're paying in dollars, if you are working off of some type of contract. So I'm not too worried about that as a hurdle. But I do think that Bitcoin's divisibility, its kind of global nature, and the digital aspects will make it appealing for someone like Argentina, who wouldn't have to charter an A330 just to get a stamp of approval on their Bitcoin.
Right, and going back to the gold standard, that was a huge cost of, if you had to ship gold, you had to pay for the ship, you had to pay for the insurance, and it really was a
Yeah,
major
there's
hindrance.
these. Sorry to interrupt. There's these great charts on like it's a time series of how much gold has been lost at sea over the years, and you'll see these huge spikes. It kind of looks like the charts of like blockchain hacks.
Wow, that's really interesting. Yeah, and a lot of Bitcoin has been lost, right?
Yeah,
Probably
yeah.
if it was at the current price it was now, it maybe would not have been lost.
Let's see, what else was in that question of yours? Oh, the chances that Satoshi Nakamoto comes back and suddenly there's more Bitcoin, right? Like Gary Gensler has floated that idea. I don't have any particular edge on that topic. The coins have been dormant for a very, very long time, and we do think, not to wade too much into the controversial topics, but if you extend the time horizon of Bitcoin for 100 years, right? There will have to be either some change to the monetary policy, or else more innovation of Bitcoin layer twos, such that paying for a $5 cup of coffee is at least possible, even if it's not ever the preferred payment rails for an American who already
Mhm.
has PayPal, Zelle, Cash App, Venmo, et cetera, et cetera, et cetera. But I did pay for surfing lessons in El Salvador using Bitcoin with a Lightning wallet, and it's a more pleasant experience than changing dollars at a physical money changer.
That's a good point. Do you think, like, let's say Bitcoin gets adopted much more than your base case of 2.5% by 2050 in terms of reserve assets, and Bitcoin really is dominating the world in the same way dollars now dominate the world, but it has a problem in the same way during the gold standard. If there was a Great Depression, everything was tied to gold, and there's deflation, and there was no real ability to increase credits. The world under a Bitcoin standard had the same problem, and after, as we emerge from this slowdown, which was not helped by the Bitcoin standard, I might say, then they say, actually, okay, we need it to be a little bit more flexible. How about 22 million, or how about 23 million? Is that even technically possible?
I think it's technically possible if there was broad community agreement. I don't have as my base case Bitcoin becoming the global monetary standard for
Mhm.
Any nation, I agree with you that nations really want the ability to print money during a downturn in order to absorb some of the economy's cyclicality, but that just having Bitcoin exist at a very small allocation will absorb some of the entropy that inevitably results from money printing. And in that way, it kind of prevents violence because people who get disillusioned can kind of demonstrate their disillusionment by buying an asset instead of lighting something on fire or something worse.
Matthew, I think out of any theory about Bitcoin adoption, yours disagrees the least with my ideological priors, going back to news biases. So maybe my biases are wrong that a global monetary standard has to be flexible to increase the credit during a downturn. Maybe that is wrong, but your that's it definitely seems the most plausible to me out of pretty much anything I've heard. So I'm glad you got a chance to share it, and people definitely should check that out. Again, the name of the piece is Bitcoin 2050 Valuation Scenarios, Global Medium of Exchange and Reserve Asset. We'll include a link in the description. Let's move on, not to Bitcoin, but to Bitcoin miners. The old business of a Bitcoin miner was you mine Bitcoin and your cost increased generally with inflation, the cost of electricity, the cost of chips, semiconductors. But the Bitcoin that you produce gradually goes down over time per the same cost because of the halving. That's the reason why there's only going to be 21 million of them is the halving. So that sounds like a challenging business. The price of Bitcoin needs to go up for the business to kind of really work. And if the price of Bitcoin is going to go up, why should I buy Bitcoin miners? I'll just buy Bitcoin. So that's the old narrative. I'm simplifying it. I'm sure there are upsides to the business that I didn't share in that simplification. But now there's an added twist. Another piece that people should read. What is that twist?
So I think you correctly observed some of the headwinds that Bitcoin miners operate under, which is their revenues go down by 50% every 4 years. Their mining machines become obsolete every 3 to 4 years, and nobody wants to lend them any money because of those factors. So they constantly have to fund themselves with equity, in other words, new shares into the market. And it's a very volatile business. You basically want to buy the miners when Bitcoin's going up and no other time. What Bitcoin miners are now doing is realizing the synergies between their business and the high performance compute market. We speak to many investors who are still unaware that Bitcoin miners now have significant exposure to AI. And from our perspective, it's a very simple synergy. AI companies need energy, and Bitcoin miners have it. And as the market is valuing the growing AI data center market, it's the access to power, especially in the near term, is commanding a premium. We are hearing from utilities and grid operators that if you want to connect to the grid in North America right now, the line can exceed 4 years. And in some markets, like Virginia and Pennsylvania, it could be 6 years. So Bitcoin miners, simply by just repurposing some percentage of their facilities, which are already sucking power to power Bitcoin ASICs, into serving the GPU market instead, the math becomes extremely compelling. And you can see that with the valuations in the public market. So we measure Bitcoin miners by the number of megawatts. How many megawatts of power do they control? The average Bitcoin miner, its market cap is roughly $3 million per megawatt. If you look at data center companies, their valuations are often north of $30 million per megawatt. So that's a 10x difference in valuation. Why is that? One, investors have no idea that these Bitcoin miners can actually serve the AI market. And two, the core business of the Bitcoin miners sucks right now. Hash price is at an all-time low. And so these stocks, their fundamentals are very challenging. And what we've seen so far year to date is that the miners who have been most aggressive in repurposing their facilities to serve the AI market those stocks have done the best, notably Core Scientific and TeraWulf. Those stocks are doubles this year, up more than 100%. The Bitcoin miners like Marathon and Riot, who are saying no thanks to this story, their stocks are down 50%. So it's a huge dispersion in performance. And like, the listeners will have to make up their own mind on whether they want to buy the companies that have kind of already done it and been rewarded, and maybe they'll do more, or if they want to make a bet that one of these miners, which has huge amounts of energy, but so far has been reluctant to embrace the market, eventually will capitulate because the investors are all in their ears, right? Like, if you do this, you don't have to issue more shares. We will lend you money. Your cost of capital will go down dramatically. Your profits will be smoothed out. Your equity will have a much higher valuation. It's the very simple thesis. And just day after day, more and more of these miners are announcing these pivots.
Yeah, this is really interesting. And Core Scientific, which you can correct me if I'm wrong, but I think I'm right in saying went bankrupt, emerged from bankruptcy, is adopting this strategy, and per your piece, they're the fourth largest Bitcoin miner by hash rate. They secured a 12-year contract with AI hyperscaler CoreWeave, projected to generate over 3.5 billion in revenue for providing 200 megawatts of infrastructure. And then in early August, CoreWeave exercised yet another option for Core Scientific to deliver 112 more megawatts of high-performance compute to host NVIDIA's GPUs. So I guess to explain for the audience, Bitcoin miners use a lot of energy, and they're now repurposing that energy and selling it to hyperscalers and data centers. Are they selling it like in the spot market, or are they selling it in forward contracts, or both?
The two choices that they have to execute on this vision. The first is to repurpose part of their facility to AI and literally buy a bunch of GPUs, install them in that physical space, and then sell the GPU computing power. That is a much more capital intensive approach. It's billions of dollars in just GPUs alone, and these companies do not have the balance sheets to fund that, nor do they have the expertise or the sales force. So a small minority of the Bitcoin miners that we highlight in the piece are doing that asset heavy model. What most of them are doing, including Core Scientific, is a simple hosting model. So they take out the Bitcoin miners from X% of their facility. They invest capital to upgrade the power, the water, the cooling, the fiber connectivity. That is a legitimate capital expense that needs to be done before you can put the GPUs in. And then they just sell that space to a GPU company like CoreWeave, who already has the relationships with NVIDIA to get the chips and who has the relationship with the end customer. And then it's a simple revenue split between the Bitcoin miner and the cluster hoster. And that second one is the more common model.
And so the first is spending it all yourself. The second is an agreement.
Correct, where it's basically a JV.
I think I started to hear rumble. Obviously, I'm much less involved in this space than you are, but I started to hear rumblings about this a few months ago. But it wasn't until your piece that I really understood the argument and was able to, analyze it with the information I now had. What is the process by which you came to this conclusion? And how early are we? How many people in the crypto space or people in the semi space, people who invest in NVIDIA, how well do you think this is understood in the market right now?
I don't think it's very well understood at all. Many investors have no idea what it takes to build a data center, what the economics are, and are unaware that power is often the single greatest line item in their OpEx. The Bitcoin miners are aware. So we're tracking about 12 of these names. 5 of them already have some type of working kind of high performance compute capacity. 4 of them are in pilots or exploring opportunities, and then there's 3 big ones who are kind of taking another approach, right? And to be fair, that other approach, for every miner that disconnects their mining machines and pivots to AI because of the Bitcoin mining algorithm and the difficulty adjustments, it actually becomes more profitable for everyone else. So, you could argue that for those who are, obstinate on this point and want to be hodlers, if Bitcoin goes up, they're likely to outperform. But we think it's very early. And in terms of the math that we've done, if you look at the cumulative net income from all of these 12 or so Bitcoin miners that we track, they are loss making. Cumulatively, they lost almost $500 million over the last 12 months. And we estimate that simply by repurposing 20% of their power capacity to AI, and we include the millions of dollars per megawatt in extra capex that needs to be done in order to make those facilities suited for AI, these stocks could still more than double, even with no change to their Bitcoin mining profits. That's how profitable this market can be. And there's very little risk of oversupply in our view, because in aggregate, the Bitcoin miners just don't control that much power to be relevant. So I think it's early. I think we're seeing a number of kind of debt offerings and converts that are getting done right after. Cipher Mining just did one yesterday, an equity offering to pay for a new data center acquisition that they say is suitable to AI. I think we're going to see a lot more of this throughout the rest of the year.
Do you think there will be a time where the business of selling energy and selling compute is so much more profitable than mining Bitcoin that they just stop mining Bitcoin altogether?
No one that I can recall has made that type of 180 where they're abandoning Bitcoin miners. A lot of these management teams are quite Bitcoin maximalists, actually, and it's the financial arbitrage here is just so compelling that if they can get a hyperscaler to lend them money at 12% or something in order to build one of these facilities, it just smooths out their entire operations and makes the core business that much more attractive too, because they now have the financial wherewithal to fund, upgrading mining machines, et cetera.
Okay, well that's really interesting. I'm glad you shared that with our audience. Matthew, what is your base case about outside of Bitcoin, how the crypto world evolves? Who will be the market leaders? Will it be L1s, ETH, Solana? Will it be other L1s? Will it be layer twos? This bull market in crypto, interestingly, I was going to say, like, some people, they act as if the price of Bitcoin is at $10,000 right now. It's like they can't handle. I thought you were able to handle drawdown in this crypto bull market. Where do you think the continued leadership will be, and why?
So I should say that we have differing opinions here. There's an investment committee which Jan van Eck chairs. We have a number of different strategies. So no one can be totally confident, and we're diversified in case one of us is wrong. My view is that digital platforms have extreme winner-take-all characteristics. That 1 to 3 kind of layer one blockchains are likely to take 99% of the economic value that's created in the space, and that we are still so early that kind of a simple strategy of buying and, if you can, staking the majors meaning like BTC, ETH, and Solana, will get you very attractive exposure to the growth of the overall ecosystem. The other approach, which my colleague manages, is to go kind of down the market cap spectrum and try to hit on, of course, the L1s and L2s, but what are going to be the killer dApps? Who has the great doxed team building the product that is better than its TradFi analog, where the token can actually accrue some value. There's very few projects that hit on all three of those, but by properly position sizing, we can make portfolios comprised of those types of assets, kind of dApps and smaller caps. And then we have a different strategy, which I'm more involved in, which is kind of the layer ones and large caps. Now, when we talk to our clients, who traditionally are more kind of institutional money managers, investment advisors, broker-owned asset managers who have been slower to adopt Bitcoin and digital assets, who are still in the kind of Bitcoin ETF 101 stage, and maybe doing a little bit of due diligence on Ethereum. They're just much earlier in their adoption um, path. So what we suggest to them is, 50 to 60% Bitcoin, and the rest in one of these private diversified strategies, or else like 70% Bitcoin and then 30% ETH. And we've done some quant work that kind of arrives at that ratio as providing the best risk-adjusted returns between BTC and ETH. So sorry, I can't answer your question as to exactly how it's going to play out. My hunch is that an overwhelmingly large share of the economic value accrues to Bitcoin plus one or two L1s, and then with riskier capital, we go hunting for the DApps, or whether it's gaming or DePIN, that have the best chance at mass adoption.
Right, dApps, of course, decentralized apps. And so you said it very casually about it's Bitcoin plus the other one or two L1s that achieve domination. There's a lot of money and a lot of emotion betting on which L1 is it going to be? Is it going to be ETH and Solana, or is it going to be something else? I mean, that's it's there's a lot there. I guess if you wanted to take a just total passive approach of the market weighting of Bitcoin relative to the total market cap, the market weighting of ETH, the market is already giving you a weighting. Do you have a view on a more optimal solution, relative to, let's take a passive index? Are you overweight ETH, underweight overweight Sol, underweight ETH? And you can either answer, Matthew, as your personal opinion, or you can say, what, for example, the market vectors owned by Van Eck, digital asset index has a weighting, and the quantitative work that informs that view. Either way you want to take it, or both.
Yeah, we've been, I think, very vocal and early bulls on Solana. So in terms of your specific question about overweights and underweights, that's an obvious one where my weighting to Solana is much higher relative to ETH than the market caps would imply. I have a kind of long history with Solana, from the sense that when I was in equities, I was a large Qualcomm holder and kind of watched the evolution of that business, where for a moment in time, Qualcomm really had the possibility of being the mobile operating system that everyone used, right? They had this product called Brew. They were integrating like location-based services against it. There was a possibility that you would have been selling ads against Brew instead of Android and iOS. Anatoly, founder of Solana, he worked on Brew during that period. Qualcomm ended up embroiled in a huge number of kind of regulatory and antitrust issues, and it kind of became clear that their legacy customers like Verizon are not software builders. So the telcos aren't going to build the next generation of software, and totally left Qualcomm and started Solana. And we can really see in Solana this kind of a contrasting philosophy, in that Solana is optimized for hardware. And you code on Solana thinking about what is the hardware going to be in 5 years. Whereas, in other words, the throughput of the chain is more dynamic, and more kind of continually improving. So of course it takes a lot of expense to buy the necessary hardware to continually stay up to speed, but that is how you replace NASDAQ with a decentralized version. Whereas Ethereum is just going for kind of a different model, emphasizing the money aspect a little earlier in its evolution, a little more similar to Bitcoin, in that let's make something which is kind of harder to change, where the money aspects can shine through from the beginning. So I own both. I want my clients to be diversified. I think these are all kind of call options on a different financial future, and you have to own a collection of call options because they all decay and can go to zero if the fundamentals don't really hit. But my SOL weighting is probably the biggest gap there between what the market cap would imply and where my personal positions are.
Interesting. And what would your biggest overweight be? What would another example of your biggest, a very big overweight relative to the entire market, and why?
Okay, so where are my other biggest overweights? I'd say as a shop, VanEck has made a number of investments in decentralized physical infrastructure projects like HiveMapper, which is a mapping application that aims to compete with Google Street View. It's built on the Solana blockchain. We're investors in Helium, which started out as an IoT network and has now pivoted to a 5G mobile network, also on Solana. There's another couple that are smaller, and I don't want to mention their names necessarily, but in terms of our weighting in that sector versus the overall market cap of that sector, probably stands out as overweight. And then I'll probably answer the other question, which is where the underweights are.
Yes, yes.
And that would be L2s, especially Ethereum L2s. So we wrote a piece with Ethereum discounted cash flow model and some of our assumptions around how that coin can act. And we're pretty straightforward that the economic model of the Ethereum L2s is not very attractive. Too many tokens that have not yet been minted. And for me personally, that's a huge variable. When you have 80% of the supply that has not yet been minted, some people say, oh, well, it makes it illiquid. And so in the up markets, it can go up a lot. Yes, that's true. But the downdrafts and the drawdowns are just much, much bigger. And we're not seeing any kind of winner take all characteristics in that space because the friction of starting a new L2 is so very low, anyone can do it. So kind of waiting for more consolidation in that space, and that would probably be our biggest underweights.
So yeah, L2 is a layer 2 on top of Ethereum. And so the idea is to do cool and fast stuff and to reduce gas fees. Why not just move it up a layer into the second layer? And that way, if we're going to have a lot of people, tons of people using the Ethereum blockchain, they can do so on L2s. Do you challenge that narrative that I just laid out, or do you challenge more the implementation of certain L2s, as well as the fact that it's kind of like, if there's 1,000 natural gas companies, you're competing against everyone else, and it's not a very good business model, and there's just too many competitors?
I think it's the implementation side. Once one of these applications truly goes viral, whether it's a messaging app or a game, a payments app, I think the winning dApps will make it seamless to onboard such that the end consumer doesn't really know they're interacting with a blockchain. We're just not there yet. Part of that is the regulatory uncertainty, whereby like Fortune 500 companies can't and won't really deploy to an L2 outside of Coinbase. I think that'll change if Trump wins, but a lot of that has to do with literally building stuff that has just been enabled. So Ethereum had a soft fork, maybe it was like a year ago, that enabled a function called account abstraction, and that makes the wallet onboarding much easier, so that like the application can put that little small bit of ETH into your wallet, so you don't have to pre-fund your wallet in order to make a transaction. But that's a relatively new innovation, and I think it's just taking time for the builders to hit on the exact model that drives users, not in the tens of thousands, but in the tens of millions.
Interesting. And so the Ethereum layer 2s, when I look at the top 50 crypto projects in terms of market cap, I'm sure there are some, but I don't think of that many. What else is underweight that's a very popular coin, or in that top 50 that you're underweight, and why? Because you're right, as a journalist, that's the interesting question to ask. So I like that you ask that to yourself.
Well, we don't own any stable coins in our private strategies, right? Because we're looking for number go up technology there, like which coins are going to outperform. But we are launching a stable coin. So
Agora.
Agora, Jan van Eck's son Nick has launched Agora, which is a dollar pegged stablecoin. Van Eck is managing the reserve assets of that fund, which is T-bills and overnight repo. And Agora is basically starting a price war with Circle and Tether. Tether is over earning, not returning any of the yield to partners or holders. Circle is returning some of the yield, but mostly to Coinbase, who owns an equity stake in them. And so we see an opportunity to be more aggressive about sharing the underlying yield with partners, whether it's exchanges, market makers, applications, anyone who wants to integrate Agora Dollar, and that should make a more valuable proposition. Now, the yield won't go to the retail investor because that's illegal in the US, but on a bilateral basis, there is the ability to share some revenue with partners in return for distribution services.
That's a big deal because I know that stablecoins paying yield, if they want to pay yield, they've had to go to Europe. So this will be available. The idea is it'll be available in the US.
Nope, not available in the US.
Okay.
Yep. Vote at the ballot in November, sir.
Okay. So what is the idea of not paying yield, but users will be able to be compensated in other ways? Explain that to me.
So it's a B2B to C model. If you mint an Agora dollar, the dollars go into a VanEck short-term bond fund, and technically Agora earns that interest. But they will pay part of that interest to the exchange, the market maker, or the DApp who makes Agora available on their platform for end users. So the end user doesn't necessarily get the yield, but the partners do, the businesses who are facilitating the distribution of Agora. I mean, it might not sound like much, but it's better than what Circle and Tether are doing.
And yeah, explain what's better about that Agora model. By the way, very good name. Than Circle and Tether, which yeah, I know in the case of Tether, I mean they are one of the one of the world's largest banks that's not regulated at
Yep.
all, and one of the world's largest unregulated banks. They make a absurd amount of money and they have very few employees. And it may be the case that, all the money is there. I mean, we didn't know they haven't been audited. But because the price of Bitcoin has gone up, they've done so well. But yeah, they are paying nothing back to users. And at least there was a time, according to their own attestations, they were investing in loans that had credit risk, unlike, a 1 month treasury bill or a bank deposit. Well, bank deposits are a different issue, but a treasury bill which has no credit risk.
Yeah, so if you go and trade on Binance, you're going to find hundreds of pairs of Tether pairs, right? Tether Bitcoin, Tether ETH, Tether Polkadot, whatever it is. I don't think that Tether is sharing part of their interest income with Binance, right? Why couldn't Binance say, you know what, we're not so into this Tether thing. We're just going to do all USDC pairs. Go F off Tether. In that case, Tether might be like, you know what, actually, we'll give you 1% of our income. But that hasn't happened. So what Agora is going to do is from the start, hey, exchange, offer some Agora pairs. We will rebate you some of our interest income from the underlying fund.
And as you said, it's going to be a price war of just basically incentivizing exchanges to use it, unlike Tether, which is not.
Correct.
What do you think is the future of stablecoins? I mean, notably you had people like Paul Ryan, who over 10 years ago were making this huge deal of Social Security we have to reduce it because the deficit, and now the debt has exploded since then. And now Republicans and Democrats, are agree that to not cut Social Security. And now he's talking about how he likes stablecoins because they can allow to fund the U.S. deficit. What do you think about stablecoins? How do you, in the future that you see, what role do they play?
Yep. So I just observe in my personal life that the number of merchants that are tacking an extra 3 or 4% onto the bill if I want to use my card has grown dramatically. And people are tired of it, and they're literally making payments at the bodega using Zelle and Venmo instead of their credit cards. That's tax evasion, I think, in many cases. I think that's not above board. But that 3% just gives an opening for someone to try to undercut on price. And why can't a large merchant, a Walmart or a Target or someone like that, adopt a stablecoin and enter into a one-on-one relationship with their customer that can save their customer the interchange fees and gives them the ability to provide like a loyalty reward directly to the customer? I think that's the most interesting use case for these stable coins. It requires some more regulatory clarity. and some brave Fortune 500 companies to either like launch an L2 or to use something like an Agora. But that's basically how I see it, is that people are just getting tired of these extra fees, and eventually the lower cost and the cutting out the middleman will bear fruit.
That's interesting. Do you ever see banks, old school banks, adopting stablecoins?
They kind of already are a little bit. There's like JPM coin, like a dollar in my bank account technically is kind of a stable coin. But I don't think banks are at the leading edge of any of this. It hurts them. Stablecoins are not deposits. So when a bank loses a deposit, they might have to cut down on $9 of loans. It makes a tricky situation for banks. All of crypto is basically the anti-bank. I don't think that you'll see banks adopting them unless the regulation in the U.S. Has a lot of regulatory capture in it. And as the stablecoin bill was written originally, it kind of does. It makes a stablecoin issuer into a bank. So then, your question is, it doesn't really make sense.
Matthew, as we approach the election, I generally try and avoid these issues, but it is very relevant. What does the crypto regulatory regime look like under a President Donald Trump? What does a crypto regulatory regime look like under a President Kamala Harris?
I think under Kamala Harris, it is more of the same until we hear differently. Uh, some optimism about a pivot. I haven't seen anything. The personnel that are in place are pretty anti-digital assets. So I would expect just more enforcement actions and no legislation. If Trump is elected, I think we see an immediate pause in the regulation by enforcement. And then I think we see a kind of a long negotiating period where the Republicans and Trump put out some proposed legislation that is a non-starter from the Dems. Like maybe it even has a Bitcoin as a reserve asset. I don't think that would happen like in 2025. And then maybe they compromise on something which eventually gets us some regulatory clarity, hopefully in the first year of that administration, but maybe not. But just the stopping the enforcement actions would change the tone in the US.
Yes. What do you make of Trump's personal views towards crypto, and what do you think of his NFTs?
I think his personal views towards crypto are evolving. It's if I were president, it'd be very tempting to say I believe in the dollar hegemony as well, because tough to put yourself in that position to totally rework a system based on some unknowns. But he's obviously become more receptive to it. He owns more than $5 million of Ethereum. He's had some very successful NFT projects, which I don't think are I don't think they're jokes, right? I've read some firsthand accounts of how much time he spent with the NFT holders at the dinner that was held earlier this year. The round 4 of these Trump NFTs just came out. I think it's a good community, and I think that's a reasonably good NFT project. His DeFi project that just came out, that I'm not so sure about. We have to wait for more information about that. Don't love the idea of putting out a Trump DeFi project right ahead of the election.
Yeah, I actually didn't hear about that. I mean, running for president, it's a pretty centralized activity. That is funny. I got to look into that. What do you think about NFTs? How has their role changed since the bull market of 2021?
So NFT volumes are down, 90% since the peak, and the NFT art market turned out to be, 99% fluff. But there is kind of a core group of NFT art projects that have created a very uh, cohesive community and engaged community. But the volumes are down a lot, and some of the NFT characteristics have kind of been subsumed by Solana meme coins. They're both they share certain things in similar, which is easy to create, easy to trade, and a low effort. But the underlying utility, which is if you own this thing, then you can unlock ownership to this other thing. And the other thing might be a JPEG, but it might also be a subscription to some piece of content, or the keys to attend some event. Uh, that's all progressing, right? The number of people interacting with Ethereum smart contracts, that's at an all-time high. The number of people interacting with Solana smart contracts, all-time high. And when we look at the collectibles market, it's very vibrant and growing. We saw some data that the average ultra high net worth investor has a 5% allocation to collectibles. That's pretty high, right? 30% of them have more than a 10% allocation to collectibles. So we do think the digital collectible market is going to grow. Some of those digital collectibles may be tied to real world assets, the actual bottle of wine, the actual Rolex watch.
You mentioned Solana meme coins, for example, dog with hat. What and some of the bull markets over the past year has been in these meme coins on Solana. There's a big debate whether this is good for crypto or bad for crypto. Good because it gets people involved. Bad because it's speculation, and if those people get hurt, they might not come back to crypto, and it's not supporting a decentralized application or something like that. Where do you fall on that spectrum of the argument?
Speculation is the lifeblood of crypto, and this has also been the reality on Solana, which uh, almost 50% of their DEX trading has been in meme coins over the last couple months, and it's becoming clear to many that Solana meme coin trading has been rife with some fraudulent activity. There's coins that have market caps of less than $1 million that are doing daily trading volumes of $10 million plus, and a lot of retail traders have lost money on meme coins. We estimate that less than 1% of the wallets on Solana's top meme coin platform are profitable.
Wow.
So Solana peaked with basically at the peak of the meme coin froth a couple months ago, and I think it'll just take some time to kind of digest that before we can move on. But I mean, this is the revealed preference. This is what people want to do. So why do we have to hate on it too much? It's all fun and games.
I understand your argument. It goes back to what I was saying about the news article. It would be great if people would read thoughtful pieces at the top of the market or at the bottom of the market. But the reality is, revealed preference. People want super bullish content at the top of the market, and at the bottom of the market, they want super bearish content. And that's what people want. And just my own personal opinion, I'm not saying Solana meme coins are a good thing, but I actually kind of have more respect for just saying, hey, yeah, we are a meme coin. Invest if you want to, trade if you want to, than saying we're going to revolutionize supply chain finance, which is a $3 trillion total addressable market, and then just having no technology or plan or implementation to back it up at all.
Well, and you can't even do that because the regulator doesn't let you, right? If you try to make a project that actually accrues value, regulator's going to tell you it's a security. So there's much less friction to just put out a meme coin and have some fun.
Right. And Matthew, one of my final questions is bridging the conversation at the beginning to the end. Bitcoin being used as a reserve asset by countries who are tired of the United States' perceived fiscal profligacy, and then Solana meme coins on the end. I think, if the term fiat means let it be so, and you can just basically print money, the spectrum of Bitcoin is extremely not fiat, and Solana meme coins are quite fiat in terms of just being able to print tokens out of nothing. All of that spectrum is called crypto. How does the central bank of Nigeria, how do you get them on board? Do you just focus on the Bitcoin part, and how do you stop them from looking at Solana meme coins and the speculation that goes on and painting the Bitcoin reserve asset with that brush?
Interesting you should mention Nigeria, because literally 48 hours ago, they just gave licenses to the first 2 crypto exchanges. One of them is Busha, which we're indirectly invested in through a venture partner. And, Busha is going to list all manner of tokens, and people are going to, trade what they want on that platform, and that's kind of the regulator giving the citizens what they want, which is access to a crypto exchange. But when it comes to the government itself allocating capital, that's where I feel like, even the regulators are very smart, and you summed it very well in your kind of fiat spectrum. They also understand that, and it goes back to the AI conversation, that there's only one crypto that actually takes real world assets, i.e., energy, and turns it into something digitally scarce. That energy can be used for lots of different things. Fair. But some of these governments this year, Argentina, Kenya, and Ethiopia, have decided to divert at least part of that energy, stranded energy, into mining Bitcoin, and that makes it very unique. So I think Ethereum will be the tokenization platform. Solana will be a tokenization platform. There may be centralized issuers who issue tokens on those platforms, but when it comes to like what the central bank is doing, and what very large institutions are doing, they're going to start with Bitcoin.
Thank you, Matthew. My final question for you is, what do you make of investing in crypto venture capital? What has VanEck's experience been with venture capital, and how do you assess the various risks and rewards or costs and benefits of investing in investing in a venture capital fund and then they allocate to these new protocols, or versus just buying liquid tokens that are already on the market?
So the world needs all kinds of investment offerings, from very early stage to very mature. We started in 2017. Jan Van Eck also first bought Bitcoin and tried to bring a Bitcoin ETF to market. And when it was clear that the regulator wouldn't allow that, he started writing checks to venture capital firms in order to get exposure to the space and build a network of people that we trusted, where we could have information. And that intelligence formed the basis of our liquid token funds that we launched in 2022. So we have exposure to both. But what we've noticed by being an LP in many of the crypto venture funds is that many of them have a little bit of style drift. They own, 30% of their fund will be in liquid tokens like Ethereum or Solana. And we just wonder if they can really focus on extracting the alpha from the very liquid part of their portfolio, when they're meant to be early stage investors, writing tickets at $10 million seed valuations, or whatever the round is. So we've kept our efforts separate. We have 2 liquid token strategies. We are launching a venture strategy later this year, but you will not see that venture strategy owning 30% of its assets in tokens. That's not the core competency. So that's our observation, is the liquid token part of the market. It's the inflows in general have been somewhat disappointing, because the regulator makes it hard for those funds to get distributed to the usual buyers like wirehouses and bank-owned asset managers. So they've gone the venture route instead. We think as the asset class matures, the liquid token category will become a bit more differentiated.
Thank you. And Matthew, in your colleague Pranav Kanada, in the first VanEck fireside chat that I did here on For Guidance, made the argument that he often tries and avoids tokens or underweights tokens that have a huge supply schedule ahead, that over the next 6 months or 1 year are going to issue a ton of tokens on the market. And the reason that those tokens are going to be minted is that they've been allocated to VCs, and then the unlock schedule, the tokens can now be sold. How seriously do you take that as an issue? Do you try and avoid those types of unlock schedules in a similar way, or at least view it as a negative that has to be weighed against other risk rewards? It's possible that the best token that you like has that schedule, and obviously you would have to invest in it. And then also this VanEck venture strategy, which I did not know about. Congratulations. Whoever's running that fund, how will they kind of address this issue?
Yeah, so in the liquid token strategies, we are definitely underweight the projects that still have like 80% of their tokens left to mint. I kind of described our Ethereum L2 positioning as being underweight for those reasons. I think it's kind of it's an incentive situation, where, because a huge percentage of crypto investment has come into VCs and not into liquid token strategies, and the VCs therefore kind of encourage projects to have this model, because they know that they'll be selling their tokens after a year anyway into retail. So I think it's just a quirk of bad incentives that is somewhat a result of the regulatory issues in the space. As to how our VC strategy, I'm going to punt on that and let you interview the manager once he is live in a month or two.
Matthew, thank you so much for joining us. People can find you on Twitter at Matthew_Sigel, Sigel. And of course, the VanEck account on Twitter is at VanEck_US. The two pieces that we analyze, your work on VanEck.com. The first is Bitcoin 2050 valuation scenarios, global medium of exchange and reserve assets. We'll link to that, as well as a piece called Bitcoin Miners AI Arbitrage Play to Boost Revenue. And this is actually a final VanEck fireside chat. So I just want to give a big thank you to VanEck for taking a bet on me and Forward Guidance and Blockworks. And it is truly been an honor. Thank you so much to VanEck. Thank you, Matthew. And thank you, everyone, for watching.
Thanks, Jack.
Hello, everyone. As always, thank you for watching. I do have some rather important news concerning myself and Forward Guidance. This will be one of my last Forward Guidance episodes. Very shortly, Felix Javin, the current host of the On the Margin podcast for Blockworks, will be taking over Forward Guidance. Felix is an extremely talented macro mind and trader, and I'm confident that I'm leaving the Forward Guidance audience in good hands. I'm very grateful to Blockworks for taking a bet on me, to VanEck for their continued faith in me, but most of all to you, the audience, who with your passion and interest in my work has allowed me to do what I love for nearly 3 years. I'll be leaving Blockworks to host my own podcast, the working title of which is Monetary Matters. Stay tuned for more information about this. But in the meantime, you'll have a few more interviews from me talking about collateralized loan obligations, trust-preferred collateralized debt obligations, balance sheet recessions, and much more. Until next time.